Hello everybody, it's Aisha Leverage, your absolute favorite realtor in the DMV, hanging out with my girl Selina Bryant. And of course, you know she is probably now your favorite lender in the DMV. Yeah, would you say so?
I would hope so.
Yeah, so we actually wanted to get together today a little bit just to kind of have some real conversation. Even Selina was sitting here just before we even cut the cameras on and got chatting, kind of giving me some game and updating me on what's going on in our market. So I think it's definitely good that we kind of just had this conversation. I want to say real talk, real estate. That's where we at.
Right. Yeah, it's crazy out there. I feel like it's, real estate has not been normalized. We have a lot of issues going on with some lawsuits, interest rate talk, right? And like all this low inventory, that type of craziness. It's definitely a different type of market, wouldn't you say? Like you've experienced in your...
Yeah, I think it's a different type of market, but I also think like the bigger thing is that it's a lot of misconceptions too within the market, and that's why I was like, it was super interesting as we were kind of talking about the Fed rates, because I know even in there's misconceptions like when they hear about like
Fed rates, rate hikes and things like that, because I'm sure it's always bolded in some sort of news or economical news or anything. When people are talking about the rates, they just say Fed are gonna hike the rates, and you're thinking, if you're in the real estate industry, you're just directly relating that, oh gosh, the interest rates are gonna go up, and you just naturally think that way because you don't know, as just a consumer, or even if you're in the business, if you're not, in the expert of an economical perspective, like the finances, then you really just think, you hear rates and you bundle all types of rates together, like mortgage rates included, right?
But when
but when the feds talk about rates, it's really just, they're really talking about stock market relative or consumer loans type rates, like credit cards.
So let's kind of talk about that though, because I thought that was very interesting as we were kind of talking about like consumer debt and kind of the illusion of having like a strong economy.
Yeah, so when feds talk about like the consumer debt, it can affect the mortgage rate in a positive way and sometimes in a negative way, but it really just depends on what's being said and what kind of information or reports are being released. So a lot of the rates, the mortgage rates, are directly relative to like mortgage-backed security bond market. So that's a complete separate market than the stock market, but we don't really have to dive deep into that type of terminology or that section, because that's really just economical information. Like you don't really need to know that. The general basis is it has a lot to do with inflation. The mortgage rates move in the same direction as inflation. So when the mortgage rates are high, that means inflation is also high. And if you just want a general Econ 101 type thing, inflation is basically the rate of spending. Like when people are spending a lot of money, inflation tends to be higher because there's a lot of money revolving in the economy. The economy is strong, right? So you can definitely tell if you are driving by and you see gas prices, and you see gas prices going up all of a sudden one week, and then sometimes they like shoot down a little bit, and you're like, oh wow, why is this happening? It's all related to inflation. So when gas prices are high, inflation is high. When prices raise, that means inflation is getting higher.
Now talk, and I hear that part, but like even to the novice, I want to know like inflation. What exactly is inflation?
Well, that's what I mean, like in terms that you can understand, like when you think inflation, it's about the rate of spending, like how much money is being revolved into the economy and how much is being spent, which therefore strengthens a lot of the stock market because you're putting money into these corporations and businesses, right? So, when you go and you're spending a lot of money, like everyone is, like during the holidays, spending is always high, and coincidentally, or it's probably not a coincidence, it makes sense because during the holidays the rates tend to be higher. Around that time, historically, the rates always tend to be a little higher during the holidays. Why? Because spending is excessively higher than the normal time, like during the year. So you can see those types of trends in the normal market. Obviously, in the past few years, it just has not been very stable. Like, there's just up and downs, like all through the year. And sometimes it's just because, the feds, they always release certain economic reports through the week, like, unemployment rate, consumer price index, like all of these economical reports just get released on a daily basis. And that fluctuates or has an effect on what direction the rates are going to go.
Okay.
So that's why what we're really talking about is more of like the misconceptions, right? It's more of like the delusion of what the federal government or what the feds or what the economists are saying and releasing as information versus what is really what we need to look into. Because even though spending is at an all-time high, we all know, like, just because you're spending a lot of money doesn't necessarily mean you have that money. You would think that the general conception is that you have the money you're spending, but in this day and age, like, how many offers on credit cards do you get, like, in the mail every day?
Time. Yes.
And how much equity did we gain in the past 3 years in, like, our homes before versus when we bought, like, versus pre-pandemic, I guess, to post-pandemic? How much equity do we all
Well, in this specific area of Virginia, a lot.
Right.
I mean, all-time highs.
Exactly.
For sure.
So we have all this money that people are dipping into, but does that mean we're making more money? Does it mean we're making enough to supplement the cost of what we're spending or what, the living cost, has gone up? Because inflation has gone up. So when gas prices raise, when eggs, milk, and all of these necessities cost more and you're not making that much more in your income, are you really spending or able to afford what you need to afford to live?
So you're basically saying it's really just a lot of people spending on credit, and credit's not real money, so it's an illusion.
Equity. They're using money that are in reserves or in savings, depleting their savings, or going into consumer debt. I mean, there's so many ways to spend money, but does that mean we're financially strong? No, that just means we're spending money, and at some point, that's gonna run out, right? Because the only money you consistently gain is appreciation, interest, if you have made an investment, or income. The main thing is income, because a lot of people don't have investments, right? Don't have residual. So that means income is solely what most people rely on to spend, and a lot of the raise of everything, and also the trend of spending on luxury goods and having to meet trends and things like that. The luxury market has skyrocketed too, the amount of money people are spending in Louis Vuitton bags and Gucci belts.
Really?
I mean, that is a lot higher now because of social media, So it's just that all of the spending is being done, but not necessarily are people making a lot more money.
So what kind of effect would you say that has on the housing market because of the illusion of
so
spending?
Because we're in such an illusion right now, the feds are able to pretty much make it seem like we are in a very strong economy because we're not in a recession or we're not close to a recession. We are spending, we're raising prices, there's not a decrease in unemployed people, so all of these things are just for show saying, hey, we're in a strong economy. But if you really dive deep into all of the factual things, or even if you just kind of ask the right questions and dig into the right stuff, you can see people's savings are depleting, people's consumer debt is at an all-time high, and at some point, don't you think that there's gonna be an end to that? Don't you think that there's gonna be something that stops? You're gonna run out, right? You're gonna run out, or you're gonna reach a max where that debt gets too much, and then we cannot ignore the facts.
What would your advice be, I guess, seeing that you are seeing this? And so I know for me, some of the things that I've been focused on with a lot of my clients is saving their money, not just necessarily paying down their debt, but then managing their debt, and keeping it at an all-time low. Because it's very easy for them to get this lump sum of tax money and be like, I'm just going to pay it all down. They pay it all down, and then guess what? By the middle of the year, they're right back in debt because